Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk at the start of a new business week on Monday the 6th of May. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. We've a lot to delve into in the world of business, finance and economics this morning, so let's get right on with it. In today's business and finance headlines, the US economy added fewer jobs than expected in April, while the unemployment rate rose, lifting hopes that the Federal Reserve will be able to cut interest rates in the coming months. Non-farm payrolls increased by 175,000 in April, down significantly from 315,000 in March. US unemployment rose slightly to 3.9%, and average hourly earnings rose 0.2% from the previous month and 3.9% from a year ago. Both rates were below consensus estimates and an encouraging sign for inflation. Also on Friday, a monthly survey by the Institute for Supply Management showed activity in the US services sector unexpectedly contracted in April for the first time in 15 months. The ISM said its index tracking the services sector fell to 49.4 last month from 51.4 in March, missing economists' forecasts for a reading of 52. It was only the second decline in activity since the pandemic-driven crash in the second quarter of 2020. Along with the broad index pullback, the prices index jumped 5.8 points to 59.2, its highest level since June, reflecting ongoing inflation pressures. Retail sales in Hong Kong fell by 7% year-on-year, returning to contraction for the first time in 15 months and falling by the most in 2 years. The total value of retail sales in March was provisionally estimated at $31.2 billion, according to the latest figures from the Census and Statistics Department released on Friday. For the first quarter of 2024, retail sales decreased by 1.3% to $101.5 billion compared with the same period in 2023. President Xi Jinping has arrived in Europe for the first time in 5 years, beginning yesterday, a 5-day trip to France, Serbia and Hungary, 3 countries that are friendlier to China than many other European states. The visit starts in France, where President Emmanuel Macron aims to deepen his connection with President Xi during the 2-day visit, as he appeals to him to urge Vladimir Putin to end Russia's war in Ukraine. On today's programme, our regular Monday commentator Alex Wong, director at Alex KY Wong Asset Management, joins us. Simon Kavanagh, partner at BDA Partners, is also here, and providing a view from mainland China will be Yanan Wu, the chairman and CEO of Surfin Group. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks enjoyed their best day in more than 2 months Friday after the US jobs report undershot expectations, bolstering hopes that investors could look forward to interest rate cuts later in the year. The Dow gained 450 points or 1.2% to settle at 38,676. The S&P 500 surged 1.3% to finish at 5,128 and notch its best day since February. The Nasdaq Composite rallied 2% to close at 18,156, with all the Magnificent 7 stocks making gains. All the major averages capped off a winning week. The Dow rose 1.1%, the Nasdaq added 1.4%, while the S&P 500 added 0.5%. The 10-year Treasury note dived to a low of 4.45% right after the non-farm payrolls report, but paired around half the move, rising back to the 4.5% level later in the session, as traders focused on the spike in the prices paid component of the ISM Services Index. The yield on the rate-sensitive 2-year note was down 7 basis points to 4.81%. Earlier in the day, the 2-year yield sank 16 basis points to the lowest level in a month. The dollar was down following the dovish jobs report, but also closed well off its lows. The US dollar index hit a low of 104.52, but the index managed to reclaim 105 as it gradually paired losses throughout the session, ending 0.33% lower at 105.08. For the week, the dollar index was down 1%. The dollar's decline was exacerbated by a sharp rally in the yen on 2 suspected interventions last week by Japanese authorities. The US dollar yen rate hit troughs beneath 152 yen. That's the lowest level for the dollar against the yen since early April. Oil prices plunged 7.3% last week, down all 5 days for the worst week in 3 months, and back to near 2-month lows. Brent crude oil settled 0.8% lower at $82.96 a barrel. Spot gold closed flat at $2,300 per ounce, and gold prices were 1.5% lower on the week. And despite a decent 7% bounce back on Friday, Bitcoin was down 1.5% on the week, trading at 63,100. In Hong Kong, the Hang Seng jumped 269 points, or 1.5%, to end at 18,476 on Friday, advancing for the 9th straight session, its longest winning streak since 2018. The city's benchmark index saw the highest level in 8 months, enjoying a 4.7% jump for the week and logging the second straight monthly gain. Looks like this morning, futures markets pointing to a gain of about 75 points for the Hang Seng. Looks like it's going to start the day trading around 18,550.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
And time to welcome our Monday morning guests. We have with us, first of all, Alex Wong, Director at Alex K.Y. Wong Asset Management, and also Simon Kavanagh, who is Partner at BDA Partners. Welcome to you both.
Hi, morning, Peter.
Morning, Peter.
Data from the US on Friday provided further evidence that the American economy is slow, led by the formerly red-hot services sector. The Labour Department's Bureau of Labour Statistics reported Friday that the US economy added fewer jobs than expected in April, while the unemployment rate rose, lifting hopes that the Federal Reserve will be able to cut interest rates in the coming months. Non-farm payrolls increased by 175,000 in April, down significantly from 315,000 in March. That was well below the 241,000 forecast by economists, and the smallest rise for 6 months. And particularly notable was the shift to just 5,000 jobs being added in the leisure and hospitality sector, compared with 53,000 in March. And the US unemployment rate, that rose slightly to 3.9%, a more encompassing rate that includes discouraged workers and those holding part-time jobs. It also edged up to 7.4%, the highest level since November 2021. Average weekly hours worked edged lower, and average hourly earnings rose 0.2% from the previous month and 3.9% from a year ago. That compares with 4.1% in March and 4.3% in February. Alex, what do you make of this jobs data? Is this a sort of signal that maybe the economy is slowing, or is it too early to say?
I think this is the one that the market like most. I think this is still okay. I think, but the growth is slowing, and the wage inflation actually is also slowing. So that is the number that I think the market would like most. And of course, I think the UK's economy is showing signs of a weakness right now. We have a weaker growth, and then we have been operating in a consistent high rates environment. So that's why I think this is quite natural to see some kind of slowdown. But the overall performance actually is not too weak to run for a recession. So I think that's the kind of number that the market like most.
Is it showing that maybe the services sector, we're starting to finally see a slowdown in that? Because that's the thing that's been really driving the economy, isn't it?
Yeah, right. The service sector has been so strong, I think, because people actually are switching some of their spending on actual goods to services. So that's why this is the sector which outperforms most. And then I think for quite some time, people probably have spent up more or less most of the savings. So I think that's why I think they are probably spending less now.
So I mean, it's still a pretty good jobs report, though, isn't it? Really, if you're adding sort of 175,000 workers, that's not bad at all.
It's not, but quite frankly, these announcements, these results were exactly what the Fed was looking for. Things slowing down, the impact of the interest rates, which have been at their level now for, I think, 10 months, starting to kick in. And it's just slowly sort of dampening the growth, the wage growth, as Alex says. Unemployment is sort of flattening. There's still a few pressures there, but this is exactly what the Fed wants to see. And I mean, the services sector, it's more than half of the US economy. And it was notable actually last week as well. Expedia, which is obviously very focused on the service sector, was one of the few companies that missed its expectations, earnings expectations, and fell fairly dramatically. So I think that's just symptomatic of things are flattening off, which is exactly what everyone wants to see, which is why the overall market itself reacted positively.
So it's not necessarily a negative sign for the economy that we're sort of seeing this sort of catch up in services sector employment after the pandemic. It's all finally seems to be coming to an end.
Yes, that's right. I mean, this is what the Fed had been hoping for, in my view. Finally, their interest rates are actually having an impact. And I mean, we're still only just 12 months. I mean, even the Q1 24 compared to Q1 23, you're particularly out here in Asia, very much there's a pandemic uplift in just those 12 months. So, no, I'm quite happy with how things are panning out in the US.
How important is this set of data compared to, say, the inflation data? Is the Fed still very much focused on the inflation data, or are they also looking at this wage data and employment data as well when it comes to making their decisions?
Well, the inflation data, I think, will still be key. I mean, that's what they're targeting, as most of the central banks do. But all these other announcements will be underlying sort of influence on that inflation data. So particularly the wage growth and the unemployment rate.
Alex, how will the Fed take this? They've got the softening in jobs growth that they were looking for, albeit just 1 month, I suppose, and we're going to get another set of data, aren't we, before the Fed meets again. So it'll be interesting to see what happens in that next set of jobs data. But how's the Fed going to react to this?
I think the most important data is still inflation, because that's the target, and I think jobs data just correlate with that. But this is showing signs. The economy is slowing a little bit, and then the wage growth factor is lowering. So I think they would like to see this kind of data. But the key is inflation. So I think people would probably still worry about the possibility of stagflation. But I think overall the picture is healthier than that.
You don't see stagflation in the economy?
Yeah, I don't think that is a very huge risk. Yeah.
Simon, do you see signs of stagflation at all? I mean, Jerome Powell was saying in his press conference last week he couldn't see it, but if you look hard enough, there are some signs in the data, aren't there? It's just whether or not we've seen enough of it.
I'm not worried about that at the moment. I think the slowing of the economy is exactly what we would sort of expect and hope to see with sort of fiscal policy and monetary policy sort of playing its part. And it's too early to say whether kind of what will happen next. But I'm not worrying about stagflation at the moment.
So are 2 rate cuts back on the table now? They sort of got priced out, didn't they, last week after we had the GDP data and the inflation data that was in that. And the markets were predicting just 1 rate cut. They've now gone back to predicting 2 rate cuts again, with the first one in September, as opposed to it being in November at the beginning of last week. Are the markets correct?
I think we'll still see one second half of the year, certainly. And that'll be an indicator that we're starting that downward trend of rates. Whether we'll get the second one this year, really it's anyone's guess. I mean, it would come late in the year, but if it slips into the first quarter 2025, I think there's quite a high likelihood of that as well.
Alex, what do you think?
Yeah, I think more or less the same. I think we probably will still be very data dependent. So this is too early to call for 2 rate cuts now.
We've still got some quite hawkish talk coming from some of the FOMC members, though. Michelle Bowman, the Federal Reserve Governor, she was saying on Friday that she's still ready to raise rates if necessary, if she doesn't see signs of inflation coming down. So presumably, is there still the risk to the upside, or has Jerome Powell removed that from consideration?
I think this is still a conditional statement. So the key is that if inflation rises again, but I don't think that is quite likely. So I'm not too worried about that. But of course, I think the key is still the overall data, how this scenario play out later on.
Well, I suppose, Simon, we could be in the position where we're going to see other central banks cut rates before the Fed, aren't they? We've got the Bank of England meeting later this week, the ECB meeting coming up. They could cut first, maybe.
Yes, and I think they will, and quite frankly, that's sign of the strength of the US economy and the time it takes to kind of pull it back a little bit. Or it's a reflection of the weakness of the European economy and the UK economy. I think so. Europe is expected to cut first. The ECB, I think, in June is the consensus, and followed by Bank of England in September. But no, sort of the European economy's only just pulled itself out of recession, and the UK is hovering around it. So the US will be last to cut rates, but that's a reflection of its strength.
Alex, we got the Bank of England, the Reserve Bank of Australia meeting this week. Probably not going to do anything this time around, but they seem to be maybe poised, or certainly Bank of England, to cut rates before the Fed.
Yeah, I think they would cut rate before the US, and that is the difference between how the economy performing. I think they probably would like to do the rate cut soon. Yeah.
And in Australia, what do you think the RBA is going to do?
Australia probably a little bit resilient still, so I think they probably still would like to cut rate, but at a slower pace, I think probably.
Let's turn our attention to Hong Kong, because we had some data out on Friday here as well. Retail sales in Hong Kong fell by 7% year on year, returning to contraction for the first time in 15 months, and also falling by the most in 2 years. The total value of retail sales in March was provisionally estimated at $31.2 billion. That's according to the latest figures from the Census and Statistics Department released on Friday. And the revised estimate of the combined total value of retail sales in January and February was up by 1.4%. For the first quarter, retail sales decreased by 1.3% compared with the same period in 2003. I mean, Alex, there's been warning signs, hasn't there, that the retail sector is struggling, but this is quite a dramatic turnaround.
I think this is a little bit distorted by the Easter holiday this time, so the number probably would be a little bit exaggerated by that, but probably need to see the combined numbers of March and April, I think. But anyway, I think the trend of Hong Kong people spending in mainland China actually is irreversible, so I think this is still a very big challenge to us. And then also the incoming tourists are spending less on average, and that is another challenge for us as well.
This is a significant change, isn't it, that maybe we've got to start getting used to, or the retail industry has really got to start planning and preparing for. This is not just a one-off. There seems to be a real change now in consumers' trends in terms of where they're spending their money vis-a-vis Hong Kong and the mainland, and how much they're spending as well.
Yeah, I think that is something which is very challenging, I think, because actually many Hong Kong people are now getting more and more used to spending in Shenzhen, and then also Chinese coming actually are spending less, and their behavior pattern actually is just different.
Simon, this is a significant trend, isn't it?
Yeah, I think that we're now looking at sort of the new normal, and it was notable that the government's aware of this. I think that the spokesman said the changing consumption patterns of visitors and residents may continue to pose challenges, and those consumption patterns have indeed changed. And I think saying that sort of retail sales have dropped by 1.3% quarter on quarter actually is overly positive, because in other data, I mean, the number of visitors to Hong Kong in the first quarter of this year was more than double what it was last year, up to sort of 11 million. So you're doubling the number of incoming tourists, and yet you're still dropping your sort of retail sales, of which tourists will be quite a large portion, I suspect.
So what have we got to do? Is there a way in which we can attract visitors back to Hong Kong, or encourage Hong Kong people to spend their weekends here? What have we got to do? Or have we just got to change our whole model in some way and think about what is it that attracts people to Hong Kong in the first place? Why would they come here?
Yeah, I think it's the latter. I think Hong Kong's days of being a retail destination have moved on, as happens all around the world and with different industries. I mean, at one point Hong Kong was a big manufacturing hub, and then that faded away, and then we were sort of a retail hub, and I think that's faded away, and we need to be more focused sort of on the services side and realize that what we were able to offer in the past is no longer sort of relevant, or the competition is such that we're kind of not going to win that.
Alex, have we got to attract a different type of tourist maybe to Hong Kong?
Yeah, if you want to attract people staying overnight, probably you have to host more significant events. I think that probably is the way to do it. Probably in terms of exhibitions and in terms of concerts and sports events, probably that is the trend going forward. The things and then we need to do because those people probably would like to spend more and also spend overnight in Hong Kong.
So we've got to become more of an entertainment hub, albeit not quite the same as Macau, not in the same way, but nevertheless along those lines that we've got to think about entertainment and maybe that's the way forward.
Yeah, probably entertainment exhibitions. I think that is kind of things that we need to do. Yeah.
What about the economy overall? We had the data there. GDP expanded 2.7% year on year. That's really in line with what the government is predicting for the full year. It falls almost in the middle of their forecast of 2.5% to 3%. The economy overall. I mean, we're seeing exports of services, which include tourist spending, rise 8%. So that's down from 21.2% growth in the last quarter. Exports of services continue to increase, and exports of goods jumped 6.7% year on year in the first quarter. Household spending, though, it grew only 1% in the first quarter, which presumably highlights the sort of the weak sentiments here. Overall, what's your thoughts on the Hong Kong economy?
I think it's still very gloomy. I think that the number actually probably is just a normalization because 1 year ago probably we are just starting to recover from the lockdown. So the number probably a little bit low base, I think. So going forward, probably we wouldn't have the kind of low base effect. So this is quite challenging for us because I think overall the retail spending and also the overall market performance actually is not too encouraging. Yeah.
Yeah, I think the household spending in particular is worrying and symptomatic of the general malaise in the economy amongst the population. So certain businesses and certain sectors, you'll always be able to find bright spots. But there's still quite a way to go before we're sort of bouncing and booming again.
Now, China's going to hold its delayed third plenum in July. The date was announced as part of a regular monthly meeting of the Politburo. The event is one of the most important in China's political calendar. It brings together about 400 state leaders, ministers, military chiefs, and so on. The Xinhua news agency reported that the third plenum is going to discuss comprehensively deepening reforms, pushing forward China-style modernisation, although it didn't provide the exact dates of the meeting. And the Politburo also hinted at measures to prop up the ailing property market and cut interest rates and signalling more policy support ahead for the economy. Alex, this has given a bit of a boost to the Hong Kong market when this was announced. Obviously, China markets have been shut for the Golden Week holiday. They reopen today. But how significant is this?
I think the market actually expecting the policy to be supportive, and they know that they have damaged the confidence over the last few years. So very hopefully they will not do that again. I think that is the key. So right now I think people are expecting those kind of supportive measures to remain, and there would not be reversed later on, just like we have been surprised by those policy which hurt the market in the past 2-3 years. So I think people expect the Chinese government learn that the confidence actually needs some time to build up. So I think this is a good thing, and I think that's why the market actually probably will not be too bad.
So you think this is going to be different this time? Because in the past we've had a lot of talk, haven't we? But we haven't really seen an awful lot of action. Do you think we are going to see some positive steps, in particular in terms of maybe on the property side?
On the property side, I think the upside may not be too much. I think in terms of policy, they probably would just support the finishing of those unfinished projects, and they're protecting the buyers but not protecting the companies, I think, and also probably not protecting the investors in the stocks or bonds. So I think they would still remain that kind of stance, I think. So overall, I don't expect too much drastic on that, but I think the market already accept that. So and they're looking for opportunity elsewhere. So probably may not still be a good place to go in China, but other parks I think would be okay.
I think there'll be some very interesting behind-the-scenes arguments, hopefully, between whether they should let private sector investment drive some of the recovery and, quite frankly, sort of let their capitalist tendencies win over state intervention. And that battle and who wins that between now and sort of July will be critical for the future direction of the Chinese economy. But my worry would be that state intervention and trying to micromanage themselves out of this excessive capacity, sort of, quite frankly, teetering on recession. It's very hard with the lack of transparency in the data to know really what's going on with sort of debt levels and things. But I don't think the government solely can manage its way out of it.
And what about on the demand side? Because when the government comes up with these policies, they always seem to be focused on the supply side, increasing investment, promoting certain sectors, high-tech sectors, new industries in the manufacturing sector, but it's all about sort of controlling and directing the supply side, which, as you say, and Simon, is going to be key. You know, whether or not some of these entrepreneurial spirits can be let free. But what about stimulating the consumer, boosting the demand side?
Well, the local domestic demand is weak, particularly for sort of high-ticket items, and you're seeing the sort of price war amongst the EVs as sort of symptomatic of that as they try and catch consumer dollars. And I mean, if your consumer local domestic demand is not going to drive sort of consumption, then you've got to look overseas, and that's partly why Xi Jinping's in Europe at the moment, trying to find buyers for this sort of overcapacity that they have in China at the moment.
Do you think in that meeting, do you think he's going to be able to avert a trade war? Because it seems the EU and China are sliding in that direction, doesn't it?
I'm not sure there's a trade war. I mean, what Macron said he wanted was reciprocity, and it was notable. I saw on Bloomberg some figures that sort of the trade balance between the EU and China, just between sort of 2020 and 2023, the amount of imports that Europe made versus its exports. The difference was 120 billion back in 2020, and that had risen to 220 billion by 2023. So a massive shift in China's favor. And I think Europe's basically going to take the view, well, hang on, we're buying an awful lot more of your stuff and you're still not opening up your market to European companies, and that now needs to change. That'll be the topics of conversation, and it was when the German government was over in Beijing a few weeks ago, and I'm sure it's what the French government will raise these couple of days.
And it's interesting, the three countries he's picked to visit, France, Hungary and Serbia. Is probably going to get a very warm welcome, isn't he, in Hungary and Serbia? They're two countries in Europe that have always been very welcoming for Chinese in investment. Maybe he's going to have a tougher time in France, but an interesting three countries to go to.
Yes, very. And I mean, Serbia and Hungary are fairly pro-Russian, and so is China. And there's been quite a lot of Chinese investment into Hungary in the automotive sector. So these are two sort of developing countries which are quite happy to take domestic Chinese investment, and they benefit from low wage rates, and yet you're within the sort of, well, Serbia is not within the EU, but Hungary is, and you're at least sort of geographically close. So they're good places for Chinese corporates to invest in. But yes, interesting choice of countries. He'll sort of get told off a little bit by France, but then he'll have a warmer welcome in Serbia and Hungary.
Alex, from an investment perspective, from a market perspective, any significance from this meeting? What are you looking out for?
If I would look to invest, I'm probably looking for opportunities in European companies, because I think China probably will need to open up a little bit more for the products over there. And also I think Europe actually would cut rates soon, so that's why I think that would be some interesting opportunity in that area. Because if even though the overall economy may not perform, but if people expect the Chinese business actually would would come back, and then the rates actually would be favorable for investment, then I think there would be some opportunities in the European side.
Okay, well, let's turn our attention to the markets. Apple suppliers very much in focus in Asia last week after the Apple results. I think, Alex, it's probably fair to say, isn't it, that they managed expectations very well, because although revenues declined, not nowhere near as much as maybe people were anticipating, and also they threw in that record stock buyback program of $110 billion. So how much are these... Is the Apple earnings going to impact the markets?
I think the impact may not be too much. I think the overall impact probably have been felt on Friday. The Nasdaq actually outperformed on Friday on this, but I think this is the impact of the massive share buyback. And then people will still be very concerned about the iPhone sales later on. So people accept that it's slowing down because the new Model X has not come out yet. But I think people are probably a little bit disappointing about the Vision Pro. So we need to see the iPhone sales to pick up again because of the upcoming model. But I think people probably would be a little bit questionable whether the iPhone would revive the competitiveness. So I think Apple probably may not have too much upside. So the strong performance is just the share buyback program influence, and also Apple had been underperforming the whole market for a long time. So this is just a strong rebound.
Simon, it's interesting what Warren Buffett said over the weekend about Apple. He said it's one of the core holdings in his portfolio. In fact, one of the top businesses after his insurance businesses, which generate a lot of their revenues. But nevertheless, he is selling Apple. He sold about 10% of it in the last quarter, according to the latest sort of filings. But nevertheless, sort of going forward, I mean, Apple needs something new, doesn't it? It needs some either new blockbuster product or some significant change to some of its existing ones.
It does. I mean, and Warren Buffett was very effusive about it, sort of saying it was one of the best American companies ever, sort of even compared to Coke and American Express. And really his selling of a stake was just rebalancing the portfolio because it was by far the largest holding that they had. But with Apple itself, I mean, it was interesting that the suppliers actually had much better results than Apple itself did. I'm not quite sure what's behind that. But I mean, I view Apple, it's had incredibly strong growth, and it's going to just have that natural life cycle of a company, and it's going to stabilize. And it happened to Microsoft sort of 10, 15 years ago, where they had their Office system on every computer, and then they were just sort of range bound from a stock point of view for years and years and years, and almost became a yield play. And I think without a big new product, Apple will fall into that sort of category. And that's not necessarily a bad thing. You just need to invest in it for slightly different reasons. I mean, it's still a very good company. It'll still sell millions of products, and it's got sort of great designs, but has it got a next great big breakthrough? I mean, its virtual reality goggles don't seem to have gone down very well. So there needs to, and they've sort of stopped doing a car. So something else needs to drive it, and without that, it'll almost become a yield play to some extent, and we might see more of these buybacks.
And we need to see how they integrate AI, don't we, into the iPhone in particular, because that's going to be the key going forward. It's been very significant in this earnings season that those companies that can show that they're investing in AI and they've got revenues coming through from it did quite well, like Microsoft, like Alphabet.
Yeah, I think I mean, it's the hot topic, but actually coming up with an integration which is useful and is used on a kind of day-to-day basis, that will be the game changer. And Apple historically has been very good at sort of identifying those and creating markets where people didn't necessarily think there was one. So we'll have to wait and see. But whether Apple does it or one of the other large tech firms gets there first remains to be seen.
Alex, let's look at the Hong Kong markets. Hong Kong stocks now on their longest winning streak since 2018. The Hang Seng rose for the 9th straight session on Friday. It's now at its highest level in 8 months. It's up 4.7% for the week. It's back in a bull market as well, up more than 20% now from its recent lows. Tech shares led the way on Friday after those results from Apple. Where do we go from here?
I think it's of course overbought, but Hong Kong had been underperforming so long, so in terms of valuation it is still okay, and I think sentiment has changed and people are looking for dips to buy now instead of selling on rally. So I think overall we would be still trending higher, but I would be more focusing on still value plays, and I think because the most convincing story would be the increased buying or increased allocation of equities from those Chinese financial institutions. So probably they would look for something which is more defensive and delivering good dividends. So I would still prefer value plays over those tech stocks. But tech stocks, of course, has a stronger momentum and stronger growth story. But I would be a little bit suspicious on their long-term sustainability. But I think value plays actually would be okay.
Are foreigners buying? Are they joining in this rally?
Yeah, I think at least some are chasing the momentum. I think some hedge funds probably are already chasing the market. Yeah.
Simon, are you convinced by this rally? Do you think it's the real deal?
Well, I think we were due a bounce back off our low. 20% is quite a bounce back. Yes, we were undervalued. I'm not sure that Alex is right in terms of focus on the value stocks, but do they kind of have their growth? It's piecemeal. And one factor I think may also be helping volumes is the cross-border flows from basically a currency hedge to some extent, holding Hong Kong dollars rather than RMB. I think the RMB is going to weaken through the course of the year. And again, it'll come back to what we hear in the third plenum. But yes, I think people may be de-risking by selling RMB and buying Hong Kong dollar.
Alex, let's look at your index, your Alex index, the 4 stocks in it: HSBC, China Mobile, CNOOC, and we just added China Resources Power to it, stock code 836. So far now, since inception, which was back in September of last year, the index is up 20.5%. That's your index of those 4 stocks. By comparison, the Hang Seng up 1.6% in the same period. So about a 19% outperformance. But you're still sticking with these 4 names.
Yeah. I think we are looking long term, so not just short term performance. I think in terms of short term, probably they would underperform the HSI for a while because people probably a bit more chasing those momentum plays and also those growth stocks, and they have been allocating their bets on those defensive ones during the market downturn. So probably they will be cashing out on the highs and then switch a little bit to those laggers. But I think in the longer run, I am still quite convinced that Chinese actually would more favor those defensive plays and with increasing dividends. So these 4 actually fits that criteria. So they have probably moderate growth, but they probably would also increase the dividend. So I think this is still the trend they like, and I don't think those insurance company or those financial institutions would be too risky in their stock selection. So I think these 4 actually will still outperform in the long run.
Now, one of the stocks, HSBC, was in the news last week. HSBC's chief executive, Noel Quinn, unexpectedly announced he's going to retire after 5 years in the role. So that sets off a hunt now for a successor. The bank's board says it's already begun a formal process to find one and is considering internal and external candidates. So Noel Quinn's been at HSBC for 37 years now and has really sort of overhauled the lender, selling off parts of its global operations to increase its focus on Asia. Does this change the outlook for HSBC in any way, Alex?
I will not read too much. I think that is his personal decision. So probably at this age, actually, we all understand enough is enough, I think. So probably it's just his personal choice. And I don't think that implies too much on the future of HSBC. I think probably they would look for someone which would be strong in wealth management. I think if you look at the results, actually, the wealth management is a quite strong sections among the operations. So I think that area actually is quite promising. So I think people probably they will look for some candidates which is strong in that area.
Simon, do you think it was just it was a sudden personal choice, wasn't it? It's a very sudden personal decision to make.
Yes, and I mean there may be nothing sort of, it may be very just sort of innocuous and one of those things. I think if you do decide to step down, it's better to, I suppose, to some extent, surprise people rather than sort of let it leak out. Just kind of get it over and done with. I thought what was very interesting, though, was Ping An coming out and saying that they weren't going to support his sort of election as a director, which I thought was, well, I mean, they're almost to some extent an activist investor within HSBC. And I mean, it would be unheard of, really, for someone that's been with the firm 37 years, risen up to be chief executive, for them not to sort of stay on for a transition period as a director would be very unusual and, quite frankly, not very good for the company. There's a lot of institutional knowledge. So what'll then, it's whether sort of Ping An was putting its marker down as to, hey, we want to have quite a sort of significant say in who the next chief executive is. So those will be interesting conversations happening behind the scenes.
And do you think this is going to open up the whole debate once again about whether HSBC should be split into an Asian bank and a UK listed bank and have a separate listing here in Hong Kong, or a separate bank headquartered here in Hong Kong?
Yeah, I don't think Ping An has given up that fight.
Okay, well, thank you both very much. Have a great week. Good to talk to you. That's Simon Kavanagh, who is partner at BDA Partners, Alex Wong, who is director of Alex K.Y. Wong Asset Management.
Peter Lewis's Money Talk.
I'm joined now by Dr. Yanan Wu, who is chairman and CEO of Surfin Group, which is headquartered in Singapore. Morning, Yanan.
Morning, Peter. How are you in Hong Kong?
Yeah, very good, thank you. So President Xi Jinping has arrived in Europe for the first time in 5 years. He's doing a 5-day trip to France, Serbia and Hungary. 3 countries that I suppose could be called friendlier to China maybe than some of the other European states. Yeah. What is he hoping to achieve from this visit?
Yes, indeed. This is actually the third time for President Xi visiting France. The last 2 was his previous term in 2014 and 2019. And so both in the springtime, it's around China-France diplomatic relationship of 50th anniversary and 55th anniversary back then. And so this is the third time at China-US, France diplomatic relationship at 60th anniversary. So it shows, President Xi highly valued the relationship with France, and that's actually carried the tradition of Chinese senior leaders, who have a very close relationship with France in the past. For example, Premier Zhou Enlai, and also Mr. Deng Xiaoping and Chen Yi, all used to study in France back in the last century. So it shows how somehow the romantic and revolutionary spirit of French culture has so much attraction to Chinese leaders. So, France, Serbia, and Hungary are also very highly valued in President Xi's trip this time. And besides, France is actually the major trading partner of China in Europe, and actually China is France's largest trading partner in Asia as well. So, and also, I think top on the agenda is the Ukraine issue. Both European governments who have serious thoughts about the future prospect of the impact of Ukraine-Russia war. So hopefully, China can bring a different angle on the dialogue channel for Russia and Ukraine, this war situation. because of inflationary risk and also geopolitical instability, and affected by this war, was very tough on the European situation currently. And the other thing I think talking about will be the so-called new energy and also global warming. And of course, the recently also Mr. Blinken and also Chancellor Scholz of Germany visit China, talk about overcapacity issues. So it's how China can rebuild a relationship with Europe regarding the new EVs and also new energy can help U.S. and also to balance Europe relationship to regain the green energy issues. Yeah.
Do you think that President Xi has a good enough relationship with President Macron to be able to somehow reassure them on Ukraine? Because this is probably the biggest single issue that's driving a wedge between the EU and China, which is President Xi's perceived support for President Putin and support for Russia overall. This has really been a big issue for the EU. Can President Xi say anything that's going to help alleviate that situation?
Yes, so definitely, I think Macron would hope President Xi can bring a constructive perspective and also dialogue channel with both Russian president and also Ukraine president as well. So currently, the war is really in a die-hard situation. So I think Macron somehow carried the Daigolo spirit, and so he wants to have an independent view from U.S. and want to be a leader for Europe. So, Chancellor Scholz just visited China, last month. So I think Macron also want to bring something on the table to speak to President Xi to see if he can bring a leadership role in this Russian-Ukraine. To end this war as soon as possible. Remember that somehow the Chancellor Merkel from last term, she's somehow have a better relationship with Russian president. So I think more dialogue with Russia. So I think Macron also want to be a leadership on that role to bring Europe out of the chaos from the current war situation.
And of the overcapacity issue, this is clearly going to be on the agenda as well. It seems that maybe the EU and China, if they're not careful, they're sliding towards a trade war, aren't they? Because the EU has launched now a lot of investigations into Chinese goods, particularly the electric vehicles investigation, which could lead to subsidies as soon as May. China has responded with an investigation into cognac, which is a very big French export to China. Can this trade war be averted? How can President Xi maybe deal with this overcapacity issue that the EU is concerned about?
Yes, so President Xi, I think he wants to indicate the sincereness of China's technology that there will be constructive role to green energy and also EV market in Europe. For example, BYD is the largest already producer in Europe anyway. So I think the China want to indicate to European leaders that on the global warming issue, on the green energy, China, Europe actually have a structural alliance, and also actually, for example, Hungary and Serbia. Why these two countries on this trip? In Serbia building the first China's technologies high-speed railway in Europe. And Hungary, Serbia will construct the first high-speed railway, and also the Serbia also built the first the highway in Europe in the country as well, and the Hungary is the first Belt and Road country in Europe. So I think China wants to indicate, to show that their technology can bring the constructive role to rebuilding, remodernization, actually reindustrialization of Europe in this era. So the green energy and also EV market definitely will be top on the agenda, especially the most recent auto show, in China, and lots of European car manufacturer also participate in the auto show. So that's also bringing up the hype of the EV market as well.
I think it's fair to say, isn't it, is going to get a warm reception, certainly in Hungary and Serbia. Hungary is probably the EU country that has the most difficult relationship with the rest of EU and has often blocked some of the EU's initiatives on both Russia and Ukraine and also on China as well. Serbia, of course, not a member of the EU, but nevertheless has a close relationship with China. So I presume President Xi is going to get a warm welcome from both those countries, and they're looking for a lot more inbound investment.
Yeah, it'll be an interesting balance, I would say. Hungary, like you just mentioned, it's very unique in the EU and also NATO. So hopefully, we'll see a different perspective from Hungary and Serbia. So that's definitely the more friendly with China from those two countries.
Now, China's going to hold its delayed third plenum in July. The Politburo announced last week. It also suggested that there's going to be more reforms of the property sector, more stimulus measures for the economy. The markets liked the news of this meeting last week, and particularly stocks in Hong Kong have surged over the last couple of weeks. What can we expect from this third plenum? Do you think we are at last going to see some concrete measures for the economy?
Indeed, the market already responded very positively since the announcement for this third plenum, and the Hong Kong market has enjoyed a very sharp rebound, during the so-called May 1st Golden Week of China last week. So I think the market shows a positive response to this few projected economic reforms, further reform in the third plenary, because normally this third plenary meetings will bring out significant reform the policies that will be announced. I think it will address both short-term and long-term in the upcoming July meeting. Short-term, like you just mentioned, is more about structural issues related to property sector and the local government vehicles. And the property sector is still facing the three issues. One is deleveraging, second, de-risking, and third, destocking. So this is really how to address that using fiscal policy in the further economic reform to show the transition model from the old model driven by infrastructure and property sector to more encourage the consumption demand, also the new manufacturing, new quality productivity development. And the other near-term issue, the future meeting, July meeting, should address is lack of how to resolve the issue of lack of effective demand. If you look at it, GDP number, of course, the first quarter GDP was very positive, 5.2%. But if you look at GDP deflator, which is adjusted after, all the pricing numbers, it actually was minus 1.1%. And that's 4 quarters in a row in the negative territory for GDP deflator. And if you look at the industrial capacity usage, is only 73.6%, and that was actually lowest since the COVID years. So if you look at last year, 2023 GDP deflator, it was minus 0.54%, and that's the second negative year since 2009, with manufacturing the biggest drag of minus 3.2%. So all these numbers shows it's not enough effective demand, despite all the monetary policy and fiscal policy so far. Of course, monetary policy still have room to put more incentive to economy, but it's already reached a constraint. M2 supply already reached 300 trillion RMB, So we need the more further fiscal policies, in addition to, the 1 trillion RMB special bond announced last year, and this year the super long bond issuance as well. So all these fiscal policy and the further more reform on economic models and system should be expected in the upcoming this third plenary meeting. And the other thing is about issues about long-term transition models. For example, recently Chinese government talking about patient capital, so-called VCP fund, will be hopefully contribute to the new China style modernization, the new quality, productivity. So hopefully with the new capital market, also more long-term patient capital could support such a transition from the old model to a new model in the upcoming decade.
Yanan, it's always a pleasure to talk to you. Thank you very much indeed for joining me this morning.
Thank you, Peter.
That's Dr. Yanan Wu, who is the chairman and CEO of Surfin Group, which is headquartered in Singapore.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Do please take a look at my daily newsletter, which has more information on some of the topics we've discussed today. You'll find that at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Mark Michelson, chairman of the Asia CEO Forum, Dime Asia, Alicia Garcia Herrero, who is the chief economist for Asia Pacific at Natixis, and our US economics correspondent, writer and broadcaster Barry Woods. See you tomorrow.
Money Talk